an arm of private equity investment bankers that they're small.
Interesting. And I'm assuming you gave them a request for that, and then they're filling it, or is it just happening sort of naturally?
Yeah. So I started out my search with just a list of 100 people that are in this space. Most of them with more introductions. So I just talked to them, and then I usually send out emails every 8 weeks or so, giving them an update. I have a one-pager on the website. And I really have found that people are very generous in this Cleveland area. So they introduce me to more people, they're sending things my way. It's been really good.
That's excellent.
I also think that now that I'm a year in, I have a lot more credibility.
That makes sense.
Doing it. I think everybody's like, oh, you're just another wannabe buyer of a company.
Right.
But I keep in touch with people, so I do think now. In the beginning, I don't think they would have referred me as much as they do now. So
that makes sense, and that's a great example of how building relationships can pay off in a longer term period than just, hey, send me a deal today.
Yeah. And I have to say, even brokers, so like I said, I had a deal. I wasn't sure if it was going to go in my pipeline, but I had a Zoom call with the owner and the broker this week, and I called the broker today to say I'm not going to move it forward.
Okay.
But even he was great, so he's got me on his list now. And he sent me an invite to the Pittsburgh Dealmakers session, which is a ticket, and it's a very good conference. I've been to it.
Okay.
So I think it's very much a relationship, and it behooves you to take care of people in this space, which you probably know because you're in it.
Yeah, no, it helps quite a bit to take care of people, and then I think staying top of mind with the every 8-week emails also help.
For sure.
I think that was probably where I found it the hardest to stay consistent.
Well, I would also say I am not happy with my decision not to use a CRM.
Oh,
because now I have literally hundreds of contacts. I keep track of everything in Google Sheets, which is not good. Now, on the other hand, all of my emails it's not like one mass email to 100 people. They're all personalized.
Right.
Which maybe gets me that better response.
Right.
But it's a lot of work then to keep track of it that way.
Do you send most of your emails out of Gmail?
Yeah.
So I've used Streak.com as my CRM for 10 years. Full disclosure, I do know the owner. We're buddies from HBS, but I'm not paying him because I know him. I haven't found a better solution in Gmail that is easy. So everything I do is in Gmail, and if I have a box for you. So I send you something. Okay, reminder, Noelle in a day, see if she's back, and I'm off. Patrick just joined. Hey, hit Patrick early next week, see how he's doing. Done. And so I'm not copying and pasting. I'm not having to worry about weird email stuff. I'm not worried about interconnectivity. And then I can use it as a to-do list, a list of contacts, deal flow, brokers, like all my broker database, my lender database, all that stuff is in Streak. So I'd highly consider it. I know other people are using other things, and there may be something that's more deal oriented, but I think what's nice about Streak too is you can go collect all your old emails and you'll be up and going in a couple of days.
Yeah, which is so, and what's funny too, so I have my Noelle at Promise 33, and then I have my Noelle Stransky at Gmail, but I typically answer from Noelle Stransky at Gmail, and then I feel like that further complicates things sometimes.
I thought so at first too. Noelle, you're probably a very unique entity in the deal-making space. People are going to remember you after a while. If you email people every 8 weeks, it may take a little while, but I still email brokers that I haven't emailed in years. And Elliott, how you doing? What have you been up to? So just keep building. Raven, how are you?
Hey, I'm doing good. How you guys doing?
Doing very well. Patrick, I said hello, but thanks for coming. I appreciate you coming and hanging out with us today.
Yeah, my pleasure. Thanks, Elliott.
So I think I'll hop in. We have about 45 minutes left. And I was talking to Noel about a CRM. I recommended Streak CRM. I don't get paid for that. It's just what I've used for 10 years. So if you get into it and have any questions about how to optimize it, I'm very happy to hop on a quick call to kind of go through how I've used it. So you guys are lucky. I did not get many questions this week. So I popped up a financial model on a deal that I did in 2016, and I was going to go through it. Now it's a little nerdy, but I like it because I think it goes through why certain parts are interesting, sort of like the QOE that I marked up the other week. But before I do that, I wanted to see were there any questions you guys had. We can split the time, or we can go a totally different direction. So it's audience choice. Patrick, you're newer. Do you have something you want to toss out?
Yeah, my questions are actually going to be financial based. So why don't you lead off with what you were gonna, and I'll see what helps pique my interest there, or I can form other questions based on what I was looking into asking anyway.
Sure. Raven, what about you?
Yeah, I'm interested in seeing the financial models. I've never done looked at financial statements before, like in a way that would be like to acquire a business. So I think that this would be something I would need to see.
Okay. And then Noel, we've hopped into a couple of models. Is this still useful for you too?
I think so. I mean, I do every model from scratch because finance is not my second nature. And my model, I don't know, do you think it's complicated? I think it's complicated.
So that's where I get in trouble because complicated for me implies it doesn't work. I don't mind the complexity as long as it gets me to the specificity I need. Like as a former scientist, it's after I have an understanding of the inputs, can I predict and understand outputs? And if the model does that, I'm good. What I have found, and I'll give you guys this, there's no shortage of like 10, 20, 30-year Wall Street folks that have terrible financial models. So don't let somebody send you some 10 tab, 20 tab thing. And as a result of it being that long, you think it's good. I've actually found, and I'm kind of telling myself, the best folks can actually get the answer quicker at the level of specificity. So I'll start off by saying for me, I've always done monthly models to look at a business. And it's a bit more arduous than annual or just looking at TTM. But I found that after I set up a financial model in a monthly basis for a business, I understand the business well enough to have a full day conversation with the owner about it. And it sort of helps me not just understand the business, but understand how things flow. And then you miss a lot of things in annual views, particularly cash flow, which would be one of the most important things to you. So that's important. The other thing that I like around monthly modeling, and it doesn't mean that I don't start off with something annual to figure out what my LOI would be and roughly how I want to do it. But when it really gets into due diligence, I want to isolate the assumptions that drive the model. What are the 10, 20, or 30 things that either are knowable and predictable or are a function of other things that, given their up or down swing, will affect the odds quite a bit. So I will admit I didn't clean this one up all that much. It's just a fresh one from 2016 when I was looking at buying a business. And it'll be a little bit complex. So what I'll probably do is just jump through the tabs on what I was creating and then hop into a little bit of the cells. And then anyone pop open a question whenever you want. Chat window would be great. So let me share my screen. Okay. Are you guys able to see that?
Yeah.
All right, cool. Um, I will start. Okay. So what I was trying to do was have a model that both helped me at my level of understand the business, and then I had equity investors who were friends of mine from Georgia Tech. So engineers, definitely mathematically sound, but not necessarily finance folks. And so the first couple of pages were sort of lining out just what was in here. This was sort of a bridge on 12 and 12 months. I won't hop into that too much. We had some growth assumptions that I popped in, another growth piece, and I'll keep moving into, okay, so how many of you guys have seen the different color-coded cells in Excel and kind of know how people on Wall Street use those? So what I've done is a green cell implies that it's pulling data from another tab. A blue cell is typically either to alert me that it's different or it's an assumption that I type in. This is probably one of the few blue cells that wasn't that. I was trying to highlight this for my engineering guys. Black is a calculation, and then red is a warning. Something's there, or you want to remember to come back to the cell. So it helps me. I've spent hours in models, go out, have a couple of dinner, a couple of drinks, come back the next day, and you can sort of forget, what you did in the third, fourth hour. So what I'm doing here is pulling in data from different cells, and I'm building the income statement in a way that makes sense so that I can sort of understand different parts of the business. Like I said, I'm going to come back to jump into detail, but if you're doing it monthly, you need to project the income statement, the balance sheet, and then the cash flow statement. So how many of you guys have spent any time in the cash flow statement? Okay. Excellent. All right. So let me come back to it, like I said. So the cash flow statement to me is one of the most interesting sheets. The nice thing is you can build it from the income statement and the balance sheet. So you guys are probably getting income statements and balance sheets from companies. Once you have those two, you can build the cash flow statement. And that's why they don't send the third one. If you're going to layer the company with debt, it's good to have a tab with debt. Capital expenditures, if that's an important piece of the business, you want to capture that. To your point, Goodwill, Noel. So how much Goodwill do I have? How long am I going to amortize it? It has an effect on EBITDA and cash flow.
What's interesting to me is I always have Goodwill as the plug on my opening balance sheet. But this company, because it was acquired 4 years ago, the owner had $1 million of Goodwill already in it.
Yeah, and then Goodwill has a kind of weird definition. So most people use it as a plug, Noel. So you're in good company. Goodwill comes when you pay more for a business than the asset support. The rest of the value is considered goodwill. So you buy a trucking company that has $1 million worth of trucks, you pay $2 million. Unless there's some other assets to allocate that value to, they're going to allocate it to goodwill. Why does that matter? It matters because depreciation and amortization are non-cash expenses. They're accounting constructs. So they give you a break on taxes without making a cash expense. So goodwill on your balance sheet that you can amortize reduces your taxable income, reduces your tax, increases your cash flow. So it's not a bad thing. It's just something that if the company has done acquisitions before, you'll see it. It's also a tipping point to know if the business has done acquisitions. So if you're looking through the balance sheet and you see goodwill, you can be fairly certain they've done some acquisitions.
And then does that Goodwill number change?
It should. So you should start with 100 and say you amortize 10 in a month, then there should be 90. It's just like two ways. Okay. Say you have $1 million building on your balance sheet and you start amortizing it. Let's say you amortize it $100,000 a year, so you're saying it's a 10-year building. At the end of year one, the first fully you amortize, you'll have $1 million building, $100,000 depreciation, and depending on how you account for it on your balance sheet, it'll either be a $900,000 net PP&E, property, something, and equipment, or it'll be $1 million with a negative account on your balance sheet for the depreciation, and then that'll all net out at the bottom. So if you think about like your car, simple, like you can, every year that your car drops in value, essentially the depreciation is made to account for the value you lost in that year by owning the car. Go for it.
If you don't mind. So I'm looking at these two models that I did, and I think, so the first one is a C Corp, and it was a stock purchase. So my Goodwill was, just call it $500,000, but there was no amortization. So my Goodwill just sat at $500,000 on my balance sheet. Is that correct?
No.
Okay, so I think I have an error then in my model.
But I would also say, Noel, I think about models differently. So when I first started 12 years ago, I thought getting to an exact answer was the only thing that mattered. I was chasing the Wall Street guys. How can I be as good as that Bank of America analyst? Yada, yada, yada. The engineer in me, get it exact. 12 years into this, I always quantify how big of an impact will this inaccuracy, right, affect the answer that I care about. Meaning, Goodwill on amortization of $500,000 may or may not have a significant enough impact on cash flow for you to want to build it in. If you think about it on opposite ends, on one end, you could have a spreadsheet with infinite numbers that would take into every assumption and up and down in a business. And you could have one model that's super simple and has 3 inputs. You're going to be somewhere in the middle. So I would encourage you guys to give yourself some grace and find something that works for you. On $500,000 of Goodwill, though, 10-year depreciation, I mean, that's $50K a year. So you just got to figure out, is that significant enough to model it in?
So if you don't mind, I'm going to keep asking questions, because in my second LOI, my Goodwill was $2.9 million. So I amortized it over 15 years, which I thought was the rule of thumb. So it was $193,000 a year, which then it was impactful to my cash flow.
That's right. That's right. And so accountants would know exactly what the sort of life of these assets are. So, Noel, maybe we take the Goodwill thing offline, and I'll show you a simple way to kind of pull it out.
Yeah, okay.
Because it runs through all the statements. So, again, okay. Have you guys seen the sources and uses tab in any of the models you've used? Yeah? No? Okay. So let's just say this is essentially all right, so uses is how the seller sees the letter of intent from a numbers perspective. You're going to pay the seller $1.4 million. There's going to be we had a guarantee fee in here for some issues. We had a working capital piece that we were buying from him, a closing cost. So this is the letter of intent from the seller's perspective, the uses. You're using your cash to buy the business. And then this is how you're affording to buy the business. These are your uses, or sorry, sources. So you're going to get a loan, some equity, and a seller note. It just helps you sort of set into what is the opening balance sheet going to look like? How are you financing the deal? So I'm moving along because some of this stuff is sort of, every model has it, but I want to move over into my assumptions tab. I think it's very important to have an assumptions tab on any model and to try your best to put as many of the assumptions on that tab as possible. The reason being, coming from an engineering background, when we did models, we would always put the assumption as close to the area in the Excel where we were going to use it. But I'll tell you, you send your model to your buddy to check it out, and you've got 25 different places in the model where you have assumptions, you're not going to be able to get a good review from your buddy. So whether you start with an assumptions tab and then build the other things, or maybe you're building the other things, and when you find an assumption, you put it on a single tab, either way, I would encourage it. And what you'll see, and this is how I do most of them, I have an intrinsic, and maybe I should blow this up a little bit. I have an intrinsic growth percent, another growth percent that I used a couple times. I'm essentially saying that expenses are growing a little bit above inflation. For some periods, I had a higher growth rate. I think there were some times when I thought there was going to be some higher expense growth. Set an assumption for payroll tax, income tax, gross margin on a business that was growing, gross margin on another business that was growing, and then some salary information here. And then there was going to be an online component of this business we were going to build out, so I put some of the assumptions there.
Elliott, can you talk more about income tax and how we should be using that in the model as far as the estimate? Because I started estimating high, and now I go in at 28%.
So for most people, and I'm a little bit making it, this is a bit more complex than what you need to get a deal done. So this is a bit more advanced. The reason why 28% minus 35% would matter is to cash flow, so to your return. It won't impact your EBITDA number, and that's what the bank's going to be looking at from a covenant perspective. So for me, I've used 28, I've used 35. I've tried to research what I thought it was going to be to get a more accurate number. But because it affects cash flow and not EBITDA, I don't spend a lot of time thinking about how specific to be. Also, tax regimes change, so it's not a constant. It's a variable that does move. All right, so this is a model that I received from a company I worked at previously. I don't share this. People have asked. I just want to say that. But I do want to say that as you find more advanced models, so what you saw over here previously, the monthly stuff, that's really for a financial person. Like, I speak in the language of finance. I'm going to have monthly models. I'm going to be able to read them in Excel, column to column. That's how I speak. Noel, your model should probably be a bit simpler than mine because it needs to speak to you, right? Patrick, I just met you. Your model needs to speak to you. Raven, same thing. So I'm showing you that you can get very similar data in a model with less specificity. So to the left, I just said you should model in monthly increments, right? Now I'm going to show you a model from a prior private equity firm that I worked for that's on an annual level. And what I want you to see is that just because the model has a bunch of tabs doesn't mean it's complicated. So this model had a historical piece where you put the sales numbers in, a few assumptions at the top, just what years were you talking about, when was the fiscal year end, stock or an asset sale, had some assumptions around your DCF stuff, so when you're going to close it. These are black cells, so these were equations, but it gives you your cost to equity. This is sort of as you guys know, this is the return that you're modeling towards to make sure that you understand whether you should do the investment or not. So in your sim, oftentimes they're going to give you projections. So I dropped in the projections here. And the reason there's more than one iteration, I'm going to zoom out, is because sometimes people will do cases. So you do an upside case, a downside case, some other case. One case is fine. If you want to get into scenarios, it's cool. Again, I'm managing specificity and understanding. So forgive me, I'm trying to go in the middle. After we did this, we would come further down. When you buy a business, you reset the balance sheet most times. So if you buy stock of the business, you kind of walk into the former owner's balance sheet. If you buy assets, you reset the balance sheet. Either way, you're going to have a very knowable balance sheet the day that you buy the business. You're going to know what accounts receivable the company's going to be transferred with. You're going to know the debt that you're using. You're going to know a lot of these things. So you put in some of the balance sheet metrics. These were all based on AR days, so you could get some of the working capital statistics. There were a few assumptions here around AR. I actually barely ever touched these. And then we'd come down, and I never touched these. These were debt metrics here. And then what I would touch is the sources and uses. So these are sources of cash, bank revolver, term facility. I'll blow this up. Cash flow loan, mezzanine, equipment line of credit. This was how much equity we're putting in. This is your cash purchase, your total purchase. So this was the inputs tab, right? There were probably 30 to 50 inputs on here. I probably touched 30 of them when I was building most models. As a result of that, and let me move this over a bit. And I'm going to zoom out a bit and then try to zoom into the pages just because it's a little bit too zoomed in for me to be functional. So we would make an assumption around transaction costs. They're typically 1 to 3% of the transaction on bigger deals. On your deals, it's the cost of diligence. So $100,000 plus or minus, depending on how you're doing diligence. There was an assumptions tab, but again, this assumptions tab, you'll see all of these cells are black. This just pulls from the input tab. So it just sets up the assumptions in a single sheet. So if people want to look at them, they can. And what I liked about this model from this company I worked at, and it may encourage you to do some of this in your model, is the executive summary wasn't just Excel lines, numbers. They actually started putting graphs in. So let me show you what some of this stuff was. So they put in a graph that showed sales and EBITDA. So you can sort of track that. And I think that number is off, but if it was right, you just have a more reasonable change from 2017 to 2018. You can model out total debt, your cash availability, book equity. You can model out EBITDA, total debt to EBITDA, debt to equity. And so don't be concerned or I would say, scared, if that's the right word, of adding graphs and charts to your models to interpret them better. Me as an engineer, I understand charts better than numbers for a very long time and still to an extent. So this might not be the stuff that you show your banker, right? But it may be the stuff that you put in your model so you understand it. And that's one of the main reasons I want to show you this. After this page, everything else was just a function of those inputs. So this is something that goes through valuation metrics, capital structure, but all of this comes from the inputs tab. Now we had an operating statement, which is essentially income statement. All of these numbers were based off assumptions on the input tab. Another view on the income statement, this was more for bankers. As you start seeing, there's more information down here at the bottom. All of this comes from the inputs tab. Balance sheet, same thing. Again, sources and uses come into play. Oh, this is the cash flow statement. It's named incorrectly. Here's your cash flow statement. This shows all the debt. The assumption here is just how long was the amortization. Everything else came off the first sheet. This was a somewhat complicated returns tab. Again, not needed, but there were only a couple of assumptions here you'd pop in and the rest would kind of flow out. Discounted cash flow. How many of you guys, have you done a discounted cash flow analysis before? No? Okay. I'm going to put a pin in that and come back to it. So I have a pin in the cash flow statement and I have a pin in discounted cash flow. I'm going to come back to both. This is your discounted cash flow projections. If there's an earnout, this was a tab for earnout. And then the rest of the stuff was proprietary to the company. Why did I show you a model that that's sort of a bit fancy and I'm not going to share? The reason I showed it is because if you really get good at the assumptions tab, if you really dial in there, it can drive most of the rest of your model. So for instance, I'll show you on my monthly tab model, those 20 assumptions that I had on that assumptions tab drove almost all those other tabs you saw. So it's just a matter of you dial into your assumptions, you kind of make the model simpler. And I think in the ideal world, you try to pull those out because those will be the things you talk about with an equity investor or whoever else around. Here's the things that we need to have confidence in to drive the model. So I wanted to talk about the cash flow statement and a discounted cash flow. But I don't think inside the model is the best place. Let me stop. The cash flow statement, it is a good place to hop in here. When it comes to discounted cash flow, Patrick, I'm going to pop into a Google sheet and do some writing because then you guys, I can share it with you in case it's helpful. Okay, so I'm going to do a little bit of 101. Raven, have you been in a lot of financial models? How are...
I've taken some like courses online and stuff, and I took some accounting classes, but that's about it. I haven't done any like modeling for business acquisition.
And then Patrick, I didn't want to put you on the spot when we first started, but hopefully we know each other a little bit. What's your background?
From a financial modeling perspective, it's pretty much the same. Been doing a lot of online education, took courses in the past, and right now I'm just trying to get to the when I'm reading prospectuses, trying to understand the numbers quicker. I've been spending all my time looking at like growth opportunities that are right for me and business strategies in general. But at the end of the day, a lot of people seem to be able to just look at the numbers much faster and know exactly what they're looking for. And it seems that varies by business model as well. So that's the extent of my experience.
Cool. So I do have a science background, which helped me with the numbers. But I will tell you that I have a heart for people who aren't sort of career finance folks because I don't think this shit is that hard. It's a lot of numbers, but they're simple. So instead of going in, I'm going to go through the cash flow statement, and then I'm going to hop into a Word doc or a Google Doc so I can write out some things that I think will be helpful to, before you get into numbers, think about financials. And I'll try to anchor it, if I can, around how to quickly get some sense of a SIM or an offering memorandum when you kind of hop into it. Let me see. Did we lose Patrick? We may have. Okay. All right. So what is the cash flow statement? So the income statement at the highest level is revenue minus costs equals profit. That's really all it is. The balance sheet is, if you think about your personal balance sheet, is how much money do you owe people and how much money do people owe you. You owing people is a liability. People owing you is an asset. It's like accounts receivable is people owing you. That's an asset. You on your payroll is accounts payable. That's you owing people. That's a liability. When you mesh those two together, you get the cash flow statement. So I talk about this quite a bit because I think it sort of grounds us in it. This is one example of an income statement: revenue, cost of sales, gross profit, operating expenses, total expenses, EBITDA adjustments, net income. Noel, can you spend EBITDA? Can you take EBITDA out of the bank? No. Can you spend profit? You can spend cash.
Oh, cash.
I'm being a bit nitpicky here, only because the primary statement that we use all the time actually doesn't have a single dollar that we can spend. And I'm going to go back through that for Patrick. He's coming back. Nathaniel, thanks for joining us. Hopefully, if you have any questions, you'll pop in. Hey, Patrick.
You got to pop up. My computer was going to restart, and I was like, hopefully I'll get another pop-up letting me stop it, but it didn't. It just restarted.
So all I did is I went through an income statement from revenue through costs down to the bottom. So again, income statement is revenue minus cost equals profit. Your balance sheet is money people owe you. Those are your assets, or amounts that people owe you. Those are your assets. Amounts that you owe people. Those are your liabilities in the simplest form. That's what those two statements are. What I went through is on the income statement, which we spend so much time on: EBITDA, cost of goods, operating expenses. You get down to the bottom and you get to profit, even net income, but you can't spend net income. You can't go into the bank and take $10 of net income out. You can't go to the bank and go take $10 of EBITDA out. You can only spend cash. When you mesh the income statement with the balance sheet, the cash flow statement actually tells you how the cash is coming out of the business. And with the two statements, you can build the third. So let me hop into the cash flow. And then can somebody do me a favor? Maybe I'm going to put a timer for 7 minutes. After 7 minutes, I want to hop into a Google Doc to answer some of Patrick's questions. So please keep me honest here. I'm going to put a timer here. Okay. So cash flow statement. All right. So this is called the indirect method of creating a cash flow statement. Just if you want to look it up so you can get some knowledge on it. What you start with is your net income. So this is right off of the income statement. And then you adjust the net income for operating adjustments, which is primarily accounts receivable, accounts payable, and inventory. You adjust it for investment adjustments. You buy a building, you sold a truck, and then you adjust it for financing adjustments. You took on debt, you took on equity, you paid off debt, you paid distributions to equity. Raven, I feel like I may have lost you a little bit.
Yeah, I mean, I just some of the terminology I'm a little, I don't know it all yet, so.
It's fine. This is how you learn. I'm glad that you're here, at least spending the time. I was at Harvard Business School and I didn't know this stuff yet. So you got to learn. Non-cash adjustments, we talked about that. Nobody charges you depreciation. Nobody charges you amortization, right? So you add those back to net income to adjust it back to cash, right? Those are non-cash expenses, accounting constructs. Now, I'm not going to spend 20 minutes on these adjustments. What I'll say is that if I'm running ABC Widget Company, right, and I have a bunch of raw materials, I have a bunch of work in progress, halfway done widgets, and I have a bunch of finished goods inventory. If I sell finished goods inventory, which I could have taken to a bank or melted down and gotten value, if I sell that to Noel and Noel gives me an IOU, which is essentially what accounts receivable is, right? You sell to somebody and they pay you in 30 days or they pay you in 60 days. You gave up cash for an IOU. That now becomes an adjustment to understand cash. You had a cash or a cash equivalent in these goods that you gave away, and you took on a piece of paper and you're hoping that that piece of paper cashes out. And it does most times, but this is an adjustment based on accounts receivable. I don't want to go deep in this. Noel, I know you're probably going to hit me on email. We can talk about it, but let's just say that there's an adjustment for accounts receivable. Same thing for a payable. It's almost like if I have Raven come help me do some military stuff out in the woods outside of Georgia, and I say, hey, I'm going to pay you in 30 days. I took on something of value and I'm giving him an IOU. So you have to adjust that to get back to cash. And I don't want to hop in too deep, but you should just know that as accounts receivable and accounts payable expand and shrink, it has an impact on cash. The easier thing to consider is on the balance sheet, accounts receivable, accounts payable, and inventory are typically considered inside of working capital. You do know if I have a finished widget and I get rid of it, I sell it, I lost value until that person pays me for it. So in that construct, it should be sort of easy to understand those are adjustments to cash. I'll move on.
Can I ask a question?
Sure.
So earlier you said the bank looks at the coverage ratio, they take the EBITDA over the cash outflows. So why wouldn't they use net income?
On some of their, so on fixed charge coverage ratio, which is a big one, they do use net income. But there's also, I think, an EBITDA over debt and some others that are EBITDA centric. So I may have misspoke in terms of all. I get in trouble that way sometimes. A lot of the bank covenants are EBITDA centric because they're going to limit how much debt you're going to put on there, and interest changes depending on how the business was operated.
Because your EBITDA is always more than your net income.
Yes. Yes. But you're going to pay your bank before you pay some other people oftentimes. the loans that you get from banks, if they start getting anxious, they'll start doing things that'll make you pay them. You'll owe Uncle Sam and pay your bank. And that's why they look at that way. Let's say I was McDonald's and I bought a bunch of buildings. I'd have to adjust my cash for that. If I was making John Deere mowers out in the heartland, I'd adjust for that, meaning I spent money to go get a building, a truck. I put a porch on the back of my office so my admin can hang out. Those are all, for here, they're zero, but if you spent money on those things, those would be adjustments too because you spent cash on those things. In addition, you have to adjust for debt. So you took on, whatever, $1.2 million of debt, and each quarter you got to pay the bank $30,000. So that comes out of the cash flow statement too. And so when you net all of that, net income minus, these are called operating adjustments. You could call them working capital adjustments, essentially. When you net out your equipment purchases and CapEx, money you spend on investing in your business, and when you net out any debt you took on or equity you took on, that's how you go from net income to cash. And so now when this line says net increase or decrease in cash, I can go to the bank and get cash. I can't go to the bank and get EBITDA. So again, Noel, we talked about how specific do you want to be. I don't want to create a bunch of doubt in anybody's head by showing you this. I want you to know it's here. For 80% of the instances, you're just fine with the EBITDA calculation. If you get into a situation where you feel kind of over your head or something's not making sense, you may want to invest some time on trying to figure out how to do the cash flow statement. So I was going to do some net present value 101 stuff for Patrick. I have a couple other folks that are on. For the folks that have been on longer, I'm going to go with this stuff. If you guys have a specific question, pop it in the chat. If I don't get to it during the call, because I do need to stop in 6 minutes, I will try to get to it afterwards. And hopefully that's fair for everyone.
You don't have to worry about giving me the one-on-one time, but I just really wanted to hop on it and see how the office hours work. I'm still trying to do my first acquisition. I already know I'm going to be using the service like yours after LOI. But like I said, I was hoping to try to get to the numbers quicker. I know it seems like when I've had conversations with people who submit LOIs and gotten through acquisitions, they can read the numbers much faster. So, I mean, can you tell me, do you think certain brokerage firms have better prospectuses for financial data? Keeping it just to online businesses, I mean, without being too high level, do the numbers vary by business model with a SaaS model versus a content versus e-commerce? Should I be looking for different things?
Great questions. The best way for me to explain this is kind of in 3 phases of understanding, because I think you're going to have to go through them. There's no way to go from a 9-minute mile to a 5-minute mile. You got to sort of inch it away, right? When you first start, you get terrible financials from everybody. They all suck, right? And you're pissed off because somebody says it's $1 million of EBITDA and it's 300,000, or even worse, it's negative, right? And no matter how good you are at reading a sheet of paper, you're not going to get to that, right? It was essentially a lie on a sheet of paper. So I'd encourage you to move out of that phase as quick as possible. Believe everything you get in a confidential information memorandum is baloney. So Elliott, how do you put together a letter of intent? I think just like when somebody tells you how big of a fish that they caught, or how much money they have in their bank account, and you take it as being directional, but not 100% accurate, that's how I read these things now. Phase 2 of my progress was take the financials to be directional. Think about who's providing you the data. If I was coming into your house that you've been in for 20 years as a broker and trying to define every single thing that's happened to your house for a new buyer, as a broker, I'm not going to be nearly as good as you, the owner, Patrick, in knowing where all the bones are buried, all the stuff. I broke this wall. The foundation's kind of messy. A business owner that's been running their business for 20 years gets a broker, that broker is not going to know. So like highly differentiated products. Do you think a business broker knows that? Highly effective capital expenditure outlay model. Do you think a broker knows that? And they're always going to tell you the best thing. So best in class, best. So what you do is you say, hey, if this is directional, it's $1 million of EBITDA. I think I'm going to pay 3 to 4 times. Hey, broker, I'm thinking 3 to 4 times. You might say a little bit longer. Hey, I was kicking it around. I heard it's like 3 to 6. It's not really the best deal. I'm at 3 to 4. See if your offer is in the ballpark. That was sort of phase 2. Phase 3 for me is now.
I got a question about the 3 to 4 times.
Hold on 1 second, Raven. Let me finish this and then I'll come back to you. Phase 3 is I don't believe squat until I get bank statements. Now that takes a very different approach, right? But if you think about it, at first I believed most of what I saw. Then I believed very little. Now, until I have like the Carfax, until I have the real data, until I'm talking to the seller in a one-on-one scenario, I'm going to give a 20 or 30% wiggle room on almost any piece of data I get. So I encourage you both to get better at reading through the financials, but I also encourage you to just trust that they're directional at best. Revenue, EBITDA, I try to get to an offer pretty quick. Raven, you had a question about, and this will be the last one for today, guys. I'm so glad you guys that came, so thank you. But I need to hop off. What do you got, Raven?
Yeah, this is a quick one. So who decides? Because not only do you have to agree with the broker and the seller on SDE, but you also have to agree on the times to earnings that you like. If I say, all right, I think this is your SDE and I want to pay you 3 times. Well, they can say, yeah, all right, I agree with SDE, but you should pay 5 times. So who decides on that?
Great question. If I want to come buy your car, who decides what the price of the car is?
The seller.
And I can tell you, hey man, Cutlass Supremes in Atlanta are only worth, $1,000, man. I'm not paying you 10 because I did this equation and Kelly Blue Book says blah, blah, blah. Until I hit your price, I don't have a deal. We use the discounted cash flow. We use the EBITDA multiples to not be way off when we put offers in. And hopefully I didn't come at you any kind of way, but just we use those things to get to what a reasonable price is. But you'll really only know a reasonable price when the seller accepts your letter of intent. The broker has asked the seller what he'll sell for because the broker needs to know if this guy's crazy because then I'm not going to get a commission from him. So he directionally has a sense, but I've talked sellers down 20% during the visit. If they like you, and the 20% might have been purchase price at close to seller note, but the seller sets the price.
All right.
Guys, thank you so much for coming. Enjoy your weekend. Thank you for the questions. If you have any more, send them to my email. I'll get to them before next week. And I'll see you guys next week.
Elliott, bye.
Thank you.
Bye.